Yo, what up everyone, and welcome back to this new live stream here on the channel. On today's live stream, we will be discussing Bitcoin, and more importantly, today is the day where the FOMC meeting will be happening. So we will be discussing the FOMC meeting today. We will be watching exactly what Jerome Powell is going to be saying, and more importantly, in exactly 12 minutes from now on, we will have the interest rate decision. And of course, we're expecting it's going to be a 25 basis point interest rate hike, and actually, it looks to be that this will be the last interest rate hike of this cycle. So that is very important to pay attention towards. What is very important, of course, because we're already anticipating this interest rate hike is going to take place, is what Jerome Powell is going to say on the meeting. The meeting will be happening in exactly 40 minutes from now on, so make sure to stick in the stream. It will be very important, and one thing I can guarantee you, and that there's going to be a lot of Bitcoin volatility in the coming one and a half hours ahead of ourselves. So without any further ado, let me first of all initially kick off this video with looking in towards where Bitcoin is heading towards, what the resistances we need to break, and basically a general market outlook. So currently we can see Bitcoin is starting to be moving back towards the upside a little bit here, and actually we're running in towards this exact level of resistance I already discussed earlier today. We can clearly see this has been the range low in the market, and currently this is the level that is exactly flipping into resistance. So this is really the level that we need to be breaking above in order to see a short-term continuation towards the upside. And if we do break above it, my next realistic target of resistance is going to be 29.8k. And if we do break above that level, then I'm actually expecting a potential continuation back up towards $31,000. What is of course the big resistance Bitcoin needs to be breaking above of. We can see on the 4-hourly time frame, Bitcoin is right now creating a consolidation phase, and it wants to be breaking out. It wants to be breaking out, and it looks to be that it will be breaking out as well in at least the coming 10 days ahead of ourselves. Maybe we're going to see a breakout happening today, but one thing is for sure, within 10 days from now on, this consolidation pattern will be breaking out. You can see it on the 4-hour, you can see it on the 12-hour, you can see it on the daily. You can clearly see Bitcoin has been consolidating, trading sideways for quite a while right now, and ever since we broke in towards this range, we've been right now consolidating between it for already 46 days. So that's quite significant. That has quite been a long day so far. And actually as well in this stream, I'm going to be looking at some trading opportunities. So after the interest rate hike decision comes out, and after Jerome is going to start talking about it, I'm going to be looking at some opportunities, and of course I'm going to try to react towards what Jerome Powell is going to say, because what he will be saying will have a massive effect on all the markets. So make sure to stick in the stream right now here. So we can see Bitcoin consolidation phase. We're just waiting to see which direction we're really breaking towards. We've been going sideways for the past 40 to 50 days right now. And I'm personally, of course, it's getting a little bit boring right now, right? We've been trading between $28,000 and $30,000 for quite a while right now, and we want to see some action. And really, I think the action is really going to take place after we see that breakout of this consolidation phase. So we just have to be a little bit more patient. Also looking at the VPVR, and I've been saying this for quite a while on the channel. In case you didn't know it yet, right now we're trading at a very important place in the market, and basically the biggest and most important support below us is at $27,000 and $27,000 for Bitcoin. You can clearly see it is that level we bounced from right here, but if we do break below that level, there's almost no volume trading in that level. You can see also once Bitcoin dropped below it, we had a significant dump towards the downside, like you can see on the left side of the screen. And once we broke above it, Bitcoin had a significant follow through this level. So this is an extremely important level of support. So let's say Bitcoin is going to dump today, it breaks below $27,000, we are in big problems, because if that happens, I'm expecting a continuation down towards $24,000. So in case we do break bearish today, this is my price target. If we break below $27,000, my price target is $24,000 for Bitcoin. I will, of course, come back if it does happen on the market. Of course, currently we're seeing a minor pump happening for Bitcoin, but let's say we do break bearish for Bitcoin, this is the pattern I will be looking at. Of course, also on the imminent short term, we can actually see that we're creating somewhat of an ascending triangle. Ascending triangles are typical continuation patterns for Bitcoin, and since we're right now trading in a bearish trend here, it's actually more likely that we're going to see a bearish continuation. So yeah, we just have to wait and see whether we're going to be breaking the resistance on the top side to, of course, confirm a bullish breakout and higher targets, or whether we're going to see that rejection and a potential breakdown for Bitcoin. So we just have to be a little bit more patient for that one. So Right now, we're approximately 8 minutes out before we're going to get the the Federal Reserve interest rate hike decision. Like you can see on the CME Group page, it's happening in 7 minutes from now on, and the likelihood of where it is going to come in at, I'm going to quickly refresh it, it's 88% chance that we're going to get a 25 basis point interest rate hike decision. So once that happens, I don't really think there's going to be a lot of volatility. We're going to see some spikes, we're going to see some volume enter the market, but of course, if we're, let's say, going to get more than 25, or if we're going to get literally no interest rate hike at all, it's going to be very bullish for markets. If we do not get an interest rate hike for for the market, it's going to pump. It's going to pump for sure. So make sure to be on the lookout for that. If it comes in around zero, I'm expecting that Bitcoin could be breaking $32,000 to $34,000 today already, so it could go very quickly. So make sure to pay attention towards that one as well. Of course, Jerome Powell in the last meeting, if you remember it, I mean, I was live streaming the last meeting as well. What he said in that meeting is that the Federal Reserve will only start to cut the rates if inflation comes down, and they will not stop until the inflation is back under control, so that's below 3%. If I am looking at true inflation, we can see for the last month and for the last 6 months, inflation has been decreasing rapidly in the US, right? It's currently somewhere around 3.8 to 3.9% around this place right now. So that is actually already a good sign. And if we're looking at what the trading economics forecast is saying, is that for next month, inflation is probably going to come in at around 4.9%. So that is definitely a very good development for the market in general. And what is very important to look at is the core inflation. And unfortunately, the core inflation still looks to be rising. And that could be maybe a negative, could have a negative effect on what Jerome Powell is going to be saying today. So be aware, inflation lookout is not necessarily that positive. And due to that fact, we could be actually still expect that Jerome Powell is going to be a little bit hawkish and not dovish on this meeting. At least that's what I'm expecting. I'm expecting the markets are going to take a dump. Because if I will also look at the last few meetings, so right now exactly in 5 minutes from now on, the interest rate hikes will come out in like 35 minutes. We're going to get the meeting. And the last time we got the meeting, this is what happened to the price action of Bitcoin. Bitcoin had a crazy dump towards the downside of an approximately 7%. We recovered afterwards, that's true, but we went in towards a bigger correction afterwards. So be aware, in the meeting before that as well, we saw a significant pump. But the last meeting as well, Jerome Powell said that he will not be hawkish until inflation is back under control. And that is very important to know. Will he be saying that again? Probably we're going to see a dump on today's meeting. So be aware, I'm expecting actually the more likely scenario is that we're going to dump. Why? Is because inflation expectations, if we're looking at core inflation and just regular inflation, looks to be a little bit sticky, especially core inflation. It has been rising last month, and probably Jerome Powell is not going to be very happy about that. So currently, we are 5 minutes out before we're going to get the interest rate hike decision. Of course, if you're watching this stream, you will be the first one to know, but I'm already telling everyone out there, I'm expecting it's going to be a 25 basis point hike. If it not will be a 25 basis point hike, it's going to be, very bullish for the markets. Of course, we're not really expecting a 50 basis point hike. So like I said, if we do have a crash and we break below $27,000, we're quite screwed for Bitcoin and we're probably going to see a bigger drop off. If I'm then looking at just purely the daily chart for Bitcoin, we can currently see that actually, for the first time ever, we have been creating a lower high. This is very important to pay attention towards, because what I do with my analysis is that I really look at the market structure. I mean, I'm a trader. I like to trade crypto. I like to trade the charts. And if I'm looking at this chart right now here, you can clearly see this is the resistance line here for Bitcoin, right? Boom. Straight away, big resistance for Bitcoin. At the same time, we can see momentum is drying up because literally the MACD is forming lower highs while price action forming higher highs. RSI forming lower highs while price action forming higher highs. So what are we doing? We're creating bearish divergence. So the momentum is right now weakening. That's clearly a thing that we can see. And at the same time, if I'm also zooming in towards the 12-hour time frame, we can actually see that Bitcoin for the first time ever has created a lower high. Here you can see a high getting created, higher high, lower high. And what will be very important to look at right now is this neckline right here. This upwards moving support right now for Bitcoin, right? You can see Bitcoin every single time we touch it, we bounce from it. And if we will, and I'm saying if, I'm not saying it has to happen, but if we will break below this level, we will be so screwed. I can tell you already, because then we're officially breaking down of this head and shoulders pattern. And a head and shoulders pattern is very easy to trade, and it plays out like 9 of the 7 times here. And I'm going to come back towards this in a minute from now on, because I do know that in exactly 3 minutes, volatility is going to hit the markets due to the fact interest rate decision will be there. So make sure to stay in the stream here, guys. We will be discussing it all. But the reason why in head and shoulders pattern is so bearish, I will draw it real quickly, is due to the fact of this. You've got a trend line, a baseline. Every single time the price chart retests it, it bounces. And it creates a higher high, but the third touch, it creates a lower high, and then it touches the level again. What means that the bounce is weaker, the trend is bearish, and you're retesting an important level of support that looks to be breaking at that point. So it's a bearish structure, and we're literally creating it right now. I'm not saying that we have to break bearish, because maybe we're not going to retest it at all. But if we come close towards the retest, it's going to be probably likely that we're also going to be breaking down. So make sure to pay attention towards that one. The structure we're currently creating, I don't really like it. I don't really buy it. I mean, I am currently also in a small short position ever since Bitcoin hit $30,000. I've been closing that short position already. I've been opening up a new one. I've been trading Bitcoin for quite a while right now here. And I'm just looking forward towards what is going to be happening next year. So many people are also talking about altcoins, guys. I will be talking about some altcoins, especially meme coins. They're absolutely exploding right now, guys. Let me know in the chat as well. Are you investing in meme coins? Let me know. I mean, I've been really getting on the train of meme coins, and I've been making a ton of money here. So I mean, I like to discuss it. So only 50 seconds out, guys, right now, before we're going to have the FOMC meeting. And basically, the FOMC is happening in 40 seconds, so that's absolutely amazing. The meeting is happening in 30 minutes, so make sure to stay in the stream for that one. So after this comes out, we have to wait another 30 minutes, and then Jerome Powell is going to start talking. And once he starts talking, the volatility is really going to hit the market, guys. So make sure to stay in the stream right now here. 30 seconds out, guys. I am checking everything right now here. I will keep you guys up to date on the chart here. This is Bitcoin. I will place it down to the 5-minute time frame right now here to give you guys an exact update about the volatility that is about to hit the markets. It's going to be probably very volatile. You can see it already happening right now. 10 seconds, guys. I'm refreshing. I'm looking at the data. 10 more seconds. Let's go. 4 more seconds. And I'm refreshing. It's always usually takes like 5 seconds, but the market reacts towards it way quicker. Refresh. It looks to be as expected. There's not really a lot happening. We're moving up right now. I'm refreshing. The page is always so busy on this time. 25 basis points, guys. We know at 25 basis points. So yeah, the Federal Reserve hiked the interest rates by 25 basis points, exactly like predicted. And basically what I will be doing here, because I told everyone out there, I want to be trading this. I want to be trading this move right now here. I actually want to be looking to open up a short position for Bitcoin. Why? Because I have been doing my prediction. I've been saying it for a while right now here. I'm actually preparing my accounts right now with my next trade here. So I'm looking to actually short this. Why? Is because I'm expecting there's actually going to be quite a significant movement towards the downside. Why? Is because I just earlier explained already, inflation looks to be sticky, and Jerome Powell is dedicated to, of course, bring inflation down at all costs. So that's why I'm expecting it. I'm going to give a more clear feedback about where I will be opening on my short position. First, I was looking at this level, but unfortunately, my entry over there already missed. But like you guys can see right here, let me quickly get it in front of the screen here. The Federal Reserve hiked the interest rates by 0.25 basis points. Exactly like predicted. Nothing new, actually. And like I told everyone out there already, the volatility is really going to hit the markets once we do see Jerome start talking. So we have to be a little bit more patient for that here. That will be happening in exactly 29 minutes from now on. So let me continue with my analysis. And I will be talking about my next trade in a second as well, because I'm looking to potentially take up a live trade here on the stream. Because I'm looking to short Bitcoin because I'm expecting it's going to go down. Already explained that. Looking then at the daily structure, I talked about this low volume below us. That looks very dangerous in my opinion. The daily time frame, I already discussed it. Creating that huge symmetrical triangle, and basically it's calm before the storm. We're just waiting to see when the next breakout is going to be happening, right? So let me continue with my analysis, and let me quickly show you guys this here, because this is absolutely epic. I'm also going to talk about some meme coins, altcoins in a second from now on. But guys, look at this for Bitcoin. I mean, if you want to be trading the market, you first have to know what's going on with Bitcoin. And if I'm looking at Bitcoin, you can see this is the 3-day time frame for Bitcoin. We're creating this rounding bonding structure. However, right now, this movement right here, it's a cheeky one. It's a very cheeky one because not many people are seeing it. Because while we are moving towards the upside, indeed, we're moving bullish, we're moving towards the upside, we can see the RSI is coming down. I already said this on the daily, but also on the 3-day time frame. RSI is forming a lower high, while price action forming a higher high. MACD forming a lower high, price action forming a higher high. Money flow index, one of the most important indicators maybe out there, creating a lower high while the price action forming a higher high. So we're creating a gigantic bearish divergence right now on the 3-day time frame for Bitcoin. So this is very important to pay attention towards here. Bitcoin is indeed moving up a little bit here. Let me also quickly check up on the dollar index. People are saying dollar index is dumping. Indeed, it is falling right now towards the downside. We'll be discussing this in a second because I've got a very important chart for the dollar index. So it could be a bullish catalyst for Bitcoin, of course. So, I mean, for this, momentum is still drying up here. Momentum is still drying up. 4-day MACD is actually crossing bearish right now for Bitcoin. Important to pay attention towards. And this is the weekly resistance to break. But let me quickly jump in towards the DXY because I need to discuss the DXY because the DXY is, of course, super important to talk about. The dollar index is basically invert correlated with Bitcoin. If the dollar index moves down, Bitcoin usually tends to move up, etc., right? So, because, yeah, the Bitcoin is calculated against the dollar. Currently, we can see literally a head and shoulders getting created for the dollar index. Very bearish for the dollar index. Very bullish for Bitcoin. So let's see how it is going to be playing out for this one. But we can clearly see left shoulder getting created. Head getting created right here. Right shoulder right here. So if the dollar index breaks below this very important level of big support, we are probably going to be seeing a significant continuation towards the downside. So let's see what we're going to go towards. Let's see where we are heading towards. But if the dollar index does decide to be breaking below this level right here, we're going to be having a significant movement towards the downside. Okay, I see something very interesting right now happening. I see a quick interesting tweet. Guys, let me get this in front of the stream, guys. This is maybe a little bit breaking news here. So if I'm looking at DB, he just tweeted something. Fed omits prior language that signaled more interest rate hikes are ahead. So maybe, guys, this is some top secret information. Maybe Jerome Powell is going to literally say that we're going to have more interest rate hikes. Let me quickly see what's getting priced in. Everyone on the market is expecting that this is going to be the last one. Let me quickly look at the CME group. Everyone is expecting it's going to be the last one. I've said it already. Probably Jerome Powell is going to be very hawkish on this meeting. I'm saying it already, and that's why I'm looking to short Bitcoin. I'm going to be opening up a short position. I'm actually going to be opening it right. I'm going to be opening it right now here, guys. Make sure to stick in the stream here. I will show it in a second, because I'm completely transparent. If the site is loading, of course, everyone's on this side, so it's not loading. So that's pretty unfortunate. Let me get the chart first back into the screen. I've been saying it. I think Bitcoin is going to dump today, and it's going to take another half an hour at least. Hopefully, we can see a small movement towards the upside. Because what I'm currently going to be doing with my trade here, so I'm going to show you guys what I'm going to do here. Let me lower the leverage a little bit here. I'm going to be putting into 15 here, 16. So I'm going to enter already 50% here. And I'm going to actually add another, let me set the limit order on 28,700. I'm going to enter the rest. So I'm not going to enter everything first. I'm going to enter it in 2 baskets. But currently, I mean, I'm personally still bearish, and I expect that we could be breaking very bearish right now from off this point. And I've been saying that $24,000 is still in the hunt for Bitcoin, and I still think actually it could be playing out. So it's a small trade, guys, right now. But maybe I'm going to be looking to give away the profits at the end of the stream. So make sure to stick in the stream. It's going to be an interesting one. Going to give more updates about it. It's no problem if we do move back towards the upside right here, fill up my next order, and then move down. So let's see what's going to be playing out right here. Furthermore, let me discuss some more interesting things here. Guys, let me know in the chat here. Are you investing in meme coins right now? Because if you're looking through Twitter, at least, if you're looking through Twitter, you go to trends for you or just viral in general, you can see Peep Coin is always there. You can, of course, currently it's FOMC as well, but meme coin is always viral. You can see it right here. Meme coin is viral. Meme coins are absolutely exploding, right? And due to the fact that meme coins are right now exploding, we can see that Ethereum is becoming extremely deflationary. At this pace, we already burned more than 143,000 Ethereum ever since the merge started. So that is quite interesting. And in this space, we're going to see basically deflation of about 0.2% a year for Ethereum, what's quite significant. What means that every 5 years, Ethereum loses 1% of its total supply. And if we're going to be looking at the forecast on how the Ethereum supply projection is at that point, in 2060, we're only going to have 91 million Ethereum left. What means that the supply decreased by approximately 25% in 40 years from now on. That's crazy, guys. This is absolutely crazy. So Ethereum getting used a lot due to the fact that the meme coins are exploding. Still, my Ethereum buy target is somewhere around 1720. I've got some meme coins, Peep. I see Pepizza, guys. I've been buying Pepizza myself here. This meme coin. I mean, to be very honest, maybe it's a very big loss that I bought it. So far, I made a significant profit on it. I wouldn't recommend anyone to be buying meme coins. I wouldn't recommend anyone to be buying this as well. It's no financial advice. And I think, yeah, you could potentially get wrecked on this. But, I mean, I've been so far made more than $30,000 on this one, the pizza. It's a meme coin. I bought in towards it. It's fun. At one point, it was even $60,000 in profit. But this is the one I think is going to be still exploding. It's currently market cap of, let me quickly check this here, guys. It's a market cap of 6 million. 6 million market cap, and I personally think my targets are around 40 to 60 million market cap. I think it's easily going to reach it, personally. But of course, it's still a risk, right? It's a meme coin. But like we do know, Peep, if I go to the Peep chart, guys, this is absolutely crazy. This coin, so many people were so bearish on it. I mean, I didn't invest in it. I mean, I did knew about it. Oh, this is not the right Peep. Oh, there's so many scams, guys. Yeah, always have to be very careful with all these scams here. But yeah, this is the Peep one. Yeah, I knew about it somewhere around here. And it still went up like 4x and I didn't bought it. So I thought, okay, I'm not going to miss out again. So I bought the pizza. And yeah, so far I've made so much money with the pizza. So let's see how it's going to be playing out here. I love pizza. I love this coin. So far it's doing absolutely great. Yeah, you should be looking in towards it yourself as well. But I like trading meme coins. And due to the fact that meme coins are getting traded so much right now, we can see that Ethereum is becoming so deflationary, right? So I love that about it. This one is also listed on CoinMarketCap, actually, what is quite good. So yeah, let's see how it's going to be playing out here. What are you guys into? Peep is Pepe. I say Peep always, but it is Pepe indeed. Where are you trading Pepizza, bro? I'm trading it on Uniswap. Just on Uniswap. But you have to be careful for scams because there are already a lot of scams of Pepizza as well. So yeah, that's basically it. So currently we can see Bitcoin moving not really that significantly yet. We're approximately 20 minutes out here, guys, before we're going to have the FOMC meeting. Where we are really waiting on, of course. Oh. Yeah. Let me quickly prepare this already. Let me get this in front of the screen real quickly. So we will be looking at the meeting. It's not starting yet, guys, but I'm quickly going to shrink it. So yeah, this will be the meeting we will be watching together. We're going to watch the meeting and we're going to be watching the price chart of Bitcoin at the same time. So if you're interested in it, make sure to stick with the stream. Share this video with your friends and family. It's going to be very important. Wojak also pumped a lot indeed, guys. There are so many altcoins that, meme coins that absolutely move like crazy. You don't even need leverage for it. It's mental. But I think it's a lot of fun to be trading meme coins. First, like last meme coin cycle, I wasn't really into it. Now I've been rolling in towards it, and it's actually so much fun. It's so much fun. And actually, this one still as well. I've been seeing Pepizza. It's really getting viral on Twitter right now here. And if you look at the potential from Pepizza compared to Pepe, it's like so much potential for that one. So that's why I like it. Of course, it's like you're taking a big risk here, but that's all about it. BitGet has got more memes. Yeah, BitGet also, guys. Yeah, Bybit is probably going to be moving away from KYC. Sorry, that KYC will become mandatory. So if you're really interested in trading without KYC, I would recommend to check out BitGet. I mean, personally, I use BitGet as well. I still use Bybit because it's just like the interface of it. But if you want to get a deposit bonus on BitGet, don't forget to check out the links in the description right now here. Also for Bybit, it's like a $30,000 deposit bonus, and without the link, it's only $4,000. So it's definitely a win-win scenario. Currently, I'm looking at the ascending triangle to see the next break for Bitcoin. But like we do know, we're in a bearish trend, so it's actually going to be likely for a continuation. But like we do know, there's probably going to be a lot of volatility due to the fact that Jerome Powell is going to start talking in a minute. So yeah, it's just all about that. It's all about that here. And of course, for Bitcoin, many people have been very bullish about Bitcoin. Many people are already bullish about Bitcoin. The fact of the matter is, for Bitcoin to really flip bullish, we need to see a break above that 31.7k. 31.7k is that previous low in the weekly time frame. And if we break above that previous low candle close here on the weekly time frame, we can confirm the break above that, then it's game on for Bitcoin. But as long as we're not breaking above that, it's definitely something to pay attention towards here. It's definitely important to know. Never missed a video. That's absolutely amazing. Do you've got any idea about Su token? Yes, Su token, of course, just launched. And I read about Su token that it's even got a bigger diluted market cap than Optimism. I mean, I've not really been looking in towards it that much here. But yeah, it's got a diluted market cap of 13 billion US dollars. So that's quite a significant diluted market cap. But due to the high amount of diluted market cap, we're also probably going to see a lot of inflation in this coin. So personally, if I would be looking at this coin straight away here, of course it's a layer 1, it's probably going to do well. It's a coin with probably a lot of inflation, so I wouldn't be buying it necessarily straight away. Only 5% is in circulation right now, so it's going to be 20 times the supply will be coming out. And probably, I can look in towards it, how long it will take here. Should I look at it? Guys, let me know. I can have a quick look at it. Let me quickly check. Yeah, I will check that for the next video. I have to do my research about it, but there's probably going to be a lot of inflation, but I don't know exactly the dates when the tokens are going to get released. Any idea where Bitcoin is heading towards? It's really depending about what the language of Jerome Powell is going to be. Yeah, I mean, Sam, actually, like, the point I bought Pizza was absolutely crazy, because I said on Twitter that I bought it, and I bought it somewhere around here, so around this region right here. So anyone that actually joined me with the buy on Pizza, they made a lot of money, because yeah, I literally made a 5x approximately. So I bought it right here, boom, it dumped a little bit here, and boom, it went up again. And right now as well, look at this extremely big volume spike, and this actually makes me quite bullish here for Pizza. Like, this was a volume spike, and you can see also on the low time frame is that actually, and if you do your research on the wallets, it was actually quite a big will that got out. What right now means that a large amount of sell pressure is gone. What's actually quite bullish for Pizza. So yeah, I'm quite excited actually, and I'm happy to see that people are actually making money from it. Nice interview from you. Yeah, I'm from the Netherlands indeed. I am actually Dutch indeed. I made a 4.5x. That's crazy, bro. I absolutely love to see that people are making money from the calls. Which is better, Dot or Link? I think Link is the better one right now to go for. I think please don't spam in the chat as well, but Link looks to be a little bit undervalued. Link looks to be a little bit undervalued. Guys, we're 15 minutes out before we're going to have the FOMC meeting. 15 minutes out. And just like I said, I'm about to enter my next order right here. So what my strategy is going to be here, I'm going to be closing my trade if I do see Bitcoin break above. Let me quickly check up here. Guys, I hope to see that this entry is going to get filled up as well. But I'm looking to, of course, let me quickly check where I want to be getting out of the trade. Of course, on a bigger perspective, I'm actually expecting, because of my own personal analysis, I'm expecting Jerome Powell is going to be hawkish. So I think we're going to drop here. There could be a lot of volatility before the meeting starts as well here, guys. So make sure to pay attention towards that one. Especially right now in the coming 30 to 40 minutes, Bitcoin is going to move the most. Bitcoin might be hitting 35k soon. I mean, we first have to clearly see a breakup of 31.7k. I think that's going to be the biggest struggle for Bitcoin. If we break above 31.7k, 35k is indeed going to be imminent. We can see funding is actually... Let me quickly check up on the funding. So looking at the funding rates for Bitcoin, we can currently see that there is an approximately 50-50% ratio. Funding rates are actually quite neutral to... Yeah, positive right here on Bitcoin actually. The USD tether margin is actually quite positive. That's quite surprising. I was expecting it was going to be negative. So it's quite neutral right now here. Altcoins significantly negative still. So many people are actually shorting altcoins, what means that we could be seeing potentially a short squeeze. So yeah, let's see how it's going to be playing out. But altcoins have been suffering a little bit here, because if you're looking at the Bitcoin dominance, you can clearly see the Bitcoin dominance has been breaking out officially towards the upside. So that is actually quite important to see. Bitcoin dominance is breaking bullish. Basically, the highest weekly candle close for the Bitcoin dominance in an approximately 104 weeks. So that's in approximately 2 years. We literally had the highest weekly candle close from the last 2 years. Oh, bro, please stop spamming. This is terrible. I'm going to give you a timeout. But this is actually quite significantly, because we created this highest candle close right here. So if we do create that, of course, weekly breakout, we're expecting right now the Bitcoin dominance is actually going to see a continuation towards the upside. What means that probably Bitcoin is going to see some positive price action right here from off this point. Sorry, what I'm saying, not necessarily positive price action, but Bitcoin is probably going to outperform altcoins from off this point. So that's going to be actually quite interesting. And many people, of course, they have been very bullish on Ethereum. I mean, I'm personally also quite bullish on Ethereum. But what I really want to be looking at is to see that breakout happening on Ethereum compared to Bitcoin, right? So this is the Ethereum compared to Bitcoin chart. And you can clearly see that Ethereum compared to Bitcoin is right and consolidating. It's getting ready for a big move here. And so far, it's not breaking out yet here. So Ethereum is not necessarily being so strong against Bitcoin recently. It had a small little bounce here, but still we're relying on the uptrend right here. And we're waiting for the breakout right here, right? So by the way, guys, before I continue with the stream here, in exactly 10 minutes from now on, Jerome Powell is going to start talking, and then the market volatility is going to kick in here. Don't forget to subscribe to the channel right now here, but more importantly, slap up that like button, guys. We only got 200 likes. Let's smash it up to 600. Easy, let's do it. Let's smash it up to 600 likes. It will be absolutely amazing. Don't forget to slap it up. Maybe pizza is the next Bitcoin. I mean, maybe pizza is going to be the world's reserve currency, guys. Maybe, could be. But I've got no clue about that one. I don't think it's going to be the next Bitcoin, but in terms of meme coins, I think it's actually quite a fun one. It's a good one, in my opinion. If you're spamming, you're going to get blocked, so please don't do it. But don't forget to slap all that like button, guys. It will be absolutely amazing. Quickly checking up DXY indeed on important stages right now here. And the DXY is probably going to see even more volatility in a moment from now on. And of course, the lower the DXY is going to be moving, the better it's going to be for Bitcoin. To be honest, Ethereum is closing in on a 30% ROI. Now a good move? I mean, for Ethereum, I've been doing my outlook already. I mean, I was bearish on the stop side right here. Many people said it already broke out because of this high right here, but this was the high I was looking at because of this low right here, right? So for Ethereum, I still think my buy target is still not reached yet, and my buy target is 1700. It's this gray box right here. So I'm not sure. I'm not necessarily buying a lot. I mean, I'm still buying dollar cost averaging every single day, because part of my strategy is just to buy more Bitcoin and Ethereum every single day. And the other part of my strategy is to trade it. So for my dollar cost average, of course, I'm buying right now. But for me to really trade it, I'm waiting for the bounce right here. I'm not willing to long it right here already. I'm just waiting a little bit longer before I can open up that long position. I mean, indeed, meme coins are never good. I'm saying it already. Meme coins are terrible investment vehicles. But there are a lot of opportunities to make money in meme coins right now, especially. That's the only thing I'm saying. At least I made a ton of money in the past 2 days here with meme coins. So for me, it's easy to talk about it. But indeed, meme coins are for sure dangerous, and I wouldn't recommend anyone to be doing it. How much do you bench? 130 kilos. Now we're going to wait for the CPI data in the coming few days. Yeah, exactly. So if we're looking at the CPI expectations, it is actually quite bad. So on the 10th of May, we're going to get the CPI data. It looks to be dropping with 0.1%. So that's not quite significant, right? And if I'm looking at core inflation, it looks to be sticky. It looks to be at the same level, 5.6% again. So that's actually quite bearish. It's actually quite bearish that the inflation looks to be sticky. And due to this forecast, I think also Jerome Powell is going to be hawkish. Rover, got any ideas why Uniswap is not really moving despite the meme coin trend? Yeah, Uniswap did had some hacks recently, but let me quickly check up here. Uniswap indeed has not been really moving. I'm not quite sure. The volume has really significantly picked up for meme coins. For DEX trading. So I'm not quite sure about it, but I do know that the token DEX, so this one has really been picking up. Look at this, guys. This is basically, DEX is basically the exchange, this one right here, dextools.io. This is basically a decentralized exchange where you can trade meme coins or just any coin that basically launched. And look at that coin. Ever since the meme coin hype started somewhere right here, it went up like another 100% in the last month. So this coin is absolutely exploding due to the hype around meme coins, basically. But Uniswap isn't really moving. I don't necessarily have a big clue why it is not happening. Whoa. Oil prices are dropping as well like crazy. I didn't know. That's good for the market. Oil prices are dropping. That's actually like pretty good for inflation. That's pretty good for inflation. So yeah, of course, the lower oil prices go, probably the faster inflation can come down as well. So it's nice that the oil prices are dropping again here, despite them cutting more than 1 million bottles a day or barrels a day. So that's quite significant. What do you talk about Apple a lot? Should we expect something huge from them? I mean, personally, of course, we do know that the CEO, Tim Cook, he owns Bitcoin and Ethereum. And I think it's just a matter of time before Apple's going to fall next into Bitcoin. To have Bitcoin on their balance sheet. So, yeah, it's going to be crazy. I think personally, Apple will be the catalyst for the next bull run. In my opinion. Trading platform Pepita. That's the trading platform I'm using, like I just told you, is DEX tools. So it's basically a decentralized exchange. But you can literally use Uniswap as well, or 1inch or whatsoever. Liquidity is provided, I think, in only Ethereum, maybe also in other pairs, but mainly Ethereum. Yeah, but in the Netherlands rule, they're also increasing the taxes on gasoline. So that's quite unfortunate. For us, it will be more expensive probably. Is it difficult to set up a company in Dubai? Super easy. MicroStrategy is selling their Bitcoin. They're in huge debt. Let me quickly check up on Sailor Tracker. Guys, this is a very interesting website. I don't know if you know it. SailorTracker.com. You can see basically the average buy price from Michael Saylor. You can see how much he's worth right now. And you can see that he's currently in a 5% loss on his Bitcoin purchase. And the last purchase was already quite a while ago. His last purchase was right here on the 5th of April. So that's approximately a month ago. MicroStrategies did their last buy to bring down the average purchasing price. But they have been buying the bottom, but not a lot. But they have been buying a little bit right there. Every single time MicroStrategy announced that they're buying, Bitcoin basically dips. So that's quite interesting. But you can currently see that they're in a loss of $200 million on their Bitcoin investment. But basically all their recent investments that they did from off 2022 have been in a profit. So that's actually quite good here. And actually also the one right here, they bought on $23,000 on March 23rd. They made more than $34 million from that investment. So that's quite nice. But overall, they're still in a $200 million loss. But yeah, their average purchasing price is around $30,000, 29.5, if I said correctly. And if I'm looking at El Salvador, they're currently holding $77 million in Bitcoin. And their average purchasing price is somewhere around $40,000. So that's quite a big difference. But they basically DCA every single day into Bitcoin. They buy every single day 1 Bitcoin. So that's actually quite interesting. They own more than 2,714 Bitcoin right now here. So that is quite interesting to see. But Michael Saylor still on a loss on his investment. Owning more than 140,000 Bitcoin, making him one of the largest Bitcoin holders out there. Render pumping. Render is so crazy. Render the coin, guys. I mean, if you like altcoins, if you like crypto in general, you will like this coin. You will love this coin. You should do your research to this coin. So this is a fundamental coin. I buy it because of fundamental reasons. Render, guys, do your research. I bought it like a while ago. I bought it literally at the bottom somewhere. I'm up significantly on Render. But this coin has got huge potential for the next bull run, especially because AI is becoming so huge in the space. I think Render will be doing extremely good here. So let me quickly set up everything because we're exactly 2 minutes out before the FOMC meeting is going to start, guys. So like you can see, boom. I'm going to place it right here on the top of the screen. I'm also going to set up my headset myself personally, so we can see it. Let me do this here. Okay, guys, we're almost ready for the FOMC meeting. Yeah, we will be watching it here at the same time while also watching at the chart. So I'm preparing a few things right now here. So yeah, currently the trade, it's a very small trade here, guys. Going to keep you guys up to date about the exact trade right here. Let me also open up some other charts here. 5-minute time frame. Boom. Let me set it to a more cleaner chart. So let me prepare this. Doing the final cuts. Make it ready. Guys, do you want to have it on the left top, the right bottom, or the right top? Let me know. Or do you want to have the meeting be for Mr. Jerome? Or do you guys want to see him? I think it's going to be just the left top here. So we're starting in exactly 1 minute, guys. I'm going to turn on the sound right now. I'm going to turn on my headset as well, because we're going to watch this together. And you guys should be hearing the sound right now. This is the intro sound, guys, so don't worry. Oh, sorry. Oh, we're starting. Powell in 1 minute, guys. I also do copy trading as well. Okay, so we're starting. We'll make it a little bit bigger, guys, so we can follow it a little bit more closer. Don't forget to slap up the like button, and we're going to start listening to Jerome Powell right now. He's going to walk up the stage anytime soon, and his words will be very important. Remember what I said. I expect the market, I don't know how it's exactly going to react, but inflation looks to be sticky, and due to that, we could see Jerome Powell also be a little bit hawkish. So we're going to be looking at the charts. We're going to look at the meeting together, and I think he's going to be walking up any moment right now here. But one thing is for sure, guys, volatility is going to hit the markets. I'm going to keep my eyes wide open on my pizza. I'm going to keep my eyes wide open on the chart of Bitcoin. So yeah, let's get it started. There he comes. He can destroy everything by one word. Let's listen, guys.
Good afternoon. Before discussing today's meeting, let me comment briefly on recent developments in the banking sector. Conditions in that sector have broadly improved since early March, and the U.S. banking system is sound and resilient. We will continue to monitor conditions in the sector. We're committed to learning the right lessons from this episode, and will work to prevent events like these from happening again. As a first step in that process, last week we released Vice Chair for Supervision Barr's review of the Federal Reserve's supervision and regulation of Silicon Valley Bank. The review's findings underscore the need to address our rules and supervisory practices to make for a stronger and more resilient banking system, and I'm confident that we will do so. From the perspective of monetary policy, our focus remains squarely on our dual mandate to promote maximum employment and stable prices for the American people. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by a 1/4 percentage point. Since early last year, we've raised interest rates by a total of 5 percentage points in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. We are also continuing to reduce our securities holdings. Looking ahead, we'll take a data-dependent approach in determining the extent to which additional policy firming may be appropriate. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. The pace of economic growth in the first quarter of this year continued to be modest at 1.1%, despite a pickup in consumer spending. Activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains very tight. Over the first 3 months of the year, job gains averaged 345,000 jobs per month. The unemployment rate remained very low in March at 3.5%. Even so, there are some signs that supply and demand in the labor market are coming back into better balance. The labor force participation rate has moved up in recent months, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. But overall, labor demand still substantially exceeds the supply of available workers. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in March, total PCE prices rose 4.2%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a 1/4 percentage point, bringing the target range to 5 to 5.25%. And we're continuing the process of significantly reducing our securities holdings. With today's action, we have raised interest rates by 5 percentage points in a little more than a year. We are seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, particularly housing and investment. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In addition, the economy is likely to face further headwinds from tighter credit conditions. Credit conditions had already been tightening over the past year or so in response to our policy actions and a softer economic outlook. But the strains that emerged in the banking sector in early March appear to be resulting in even tighter credit conditions for households and businesses. In turn, these tighter credit conditions are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain. In light of these uncertain headwinds, along with monetary policy restraint we've put in place, our future policy actions will depend on how events unfold. In determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We will make that determination meeting by meeting based on the totality of incoming data and their implications for the outlook for economic activity and inflation. And we are prepared to do more if greater monetary policy restraint is warranted. We remain committed to bringing inflation back down to our 2% goal and to keep our longer-term inflation expectations well anchored.
You was going to say this.
Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thanks, Gina.
It's funny, he always says the same thing, meeting after meeting.
New York Times. Thanks for taking our questions. I wonder if you could tell us whether we should read the statement today as a suggestion that the committee is prepared to pause interest rate increases in June. And I also wonder if the Fed staff has in any way revised their forecast for a mild recession from the March minutes. And if so, what a recession like what they're envisioning would look and feel like when it comes to, for example, the unemployment rate.
So, taking your question, of course, today our decision was to raise the federal funds rate by 25 basis points. A decision on a pause was not made today. You will have noticed that in the statement from March, we had a sentence that said the committee anticipates that some additional policy firming may be appropriate. That sentence is not in the statement anymore. We took that out, and instead we're saying that in determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time, the committee will take into account certain factors. So that's a meaningful change that we're no longer saying that we anticipate. And so we'll be driven by incoming data, meeting by meeting, and we'll approach that question at the June meeting. So the staff's forecast is so. Let me start by saying that that's not my own most likely case, which is really that the economy will continue to grow at a modest rate this year. And I think that's, so different people in the committee have different forecasts. That's my own assessment of the most likely path. Staff produces its own forecast, and it's independent of the forecasts of the participants, which include the governors and the Reserve Bank presidents, of course. And we think this is a healthy thing, that the staff is writing down what they really think. They're not especially influenced by what the governors think, and vice versa. The governors are not taking what the staff says and just writing that down. So it's actually good that the staff and individual participants can have different perspectives. So broadly, the forecast was for a mild recession, and by that I would characterize as one in which the rise in unemployment is smaller than has been typical in modern era recessions. I wouldn't want to characterize the staff's forecast for this meeting. We'll leave that to the minutes, but broadly similar to that.
Rachel.
Thank you, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. I'm wondering if you can talk about the account of possible effects of a debt limit standoff. You've said repeatedly that the ceiling must be raised, but do you see any economics effects of even getting close to a default, and what type of situation would that look like?
So I wouldn't want to speculate specifically, but I will say this. These are fiscal policy matters, for starters, and they're for Congress and the administration, for the elected parts of the government to deal with, and they're really consigned to them. From our standpoint, I would just say this. It's essential that the debt ceiling be raised in a timely way so that the U.S. government can pay all of its bills when they're due. A failure to do that would be unprecedented. We'd be in uncharted territory, and the consequences to the U.S. economy would be highly uncertain and could be quite averse. So I'll just leave it there. We don't give advice to either side. We just would point out that it's very important that this be done. And the other point I'll make about that, though, is that no one should assume that the Fed can protect the economy from the potential, short and long-term effects of a failure to pay our bills on time. It would be so uncertain that it's just as important that we never get to a place where we're actually talking about or even having a situation where the U.S. government's not paying its bills.
And just to follow up, was discussion around the uncertainty of a possible standoff, did that affect today's monetary policy decision at all?
I wouldn't say that it did. It was, of course, it's something that came up. We talk a lot about risks to the outlook, and that come up. A number of people did raise that as a risk to the outlook. I wouldn't say that it was important in today's monetary policy decision yet.
Steve.
Chairman, oh, thank you. Yeah, Steve Leisman, CNBC. Can you tell us what the Federal Reserve Board did in the wake of that February presentation where you were informed that Silicon Valley Bank and other banks were experiencing interest rate risks? And can you tell me what supervisory actions you've done in the wake of the recent bank failures to make sure that banks are currently appropriately managing interest rate risk? And kind of part three, but it's all the same question here. Do you still think this separation principle that monetary policy and supervision can be handled with different tools? Thank you.
Sure. So the February 14th presentation, I didn't remember it very well, but now, of course, I've gone back and looked at it very carefully. I did remember it. And what it was a general presentation. It was an informational briefing of the whole board, the entire board. I think all members were there. And it was about interest rate risk in the banks and lots of data. And there was one page on Silicon Valley Bank, which talked about the amount of losses mark-to-market losses they had in their portfolio. There was nothing in it about, that I recall anyway, about the risk of a bank run. So it was, I think the takeaway was they were going away to do an assessment, a horizontal assessment of banks. It wasn't it wasn't presented as an urgent or alarming situation. It was presented as an informational, non-decisional kind of a thing, and I thought it was a good presentation, and as I said, did remember it. In terms of what we're doing, of course, I think banks themselves or many banks are now are attending to liquidity and taking opportunity now, really since the events of early March, to build liquidity. You asked about the separation principle. Like so many things, it's very useful. But ultimately, it has its limits. I mean, I think in this particular case, we have found that the monetary policy tools and the financial stability tools are not in conflict. They're working well together. We've used our financial stability tools to support banks through our lending facilities, and at the same time, we've been able to use our monetary policy tools to foster maximum employment and price stability.
Mr. Chairman, I'm sorry. I don't mean to be argumentative, but the staff report said SVB has significant interest rate risk. It said interest rate risk measurements failed at SVB, and it said banks with large unrealized losses face significant safety and soundness risk. Why was that not alarming?
Well, I mean, I didn't say it wasn't alarming. It was, they're pointing out something that they're working on and that they're on the case. That I'm not sure whether they mentioned. I think they did actually. They mentioned that they had taken regulatory action, or supervisory action in the form of matters requiring attention. So I think that was also in the presentation. I think it was to say, yes, this is a bank, and there are many other banks that are experiencing these things, and we're on the case.
Thank you.
Go to Victoria.
Hi, Chair Powell. I wanted to ask you, obviously, with the recent bank turmoil, we've seen multiple banks buy other banks, and I was just curious whether you think that further consolidation in the banking sector would increase or decrease financial stability, and whether you have any concerns about the biggest bank in the U.S. Getting even larger.
So, we certainly don't, and I don't have an agenda to further consolidate banks. Consolidation has been a factor in the U.S. banking industry really since interstate banking, and before that even. It goes back more than 30 years. When I was in the government a while back, I think there were 14,000 banks. Now there are 4,000 and change. So that's going on. I personally have long felt that having small, medium, and large-sized banks is a great part of our banking system. The community banks serve particular customers very well. Regional banks serve very important purposes, and the various kinds of GSIBs do as well. So I think it's healthy to have a range of different kinds of banks doing different things. I think that's a positive thing. Is it a financial? So I would just say, in terms of J.P. Morgan buying First Republic, the FDIC really runs the process of closing and selling a closed bank completely. That is their role, so I really don't have a comment on that process. As you know, there's an exception to the deposit cap for a failing bank. So it was legitimate, and I think the FDIC, I believe, is bound by law to take the bid that is the least cost bid. So I would assume that's what they did.
So, but do you have any concerns about
The fact that they're getting larger in general.
So I think it's probably good policy that we don't want the largest banks doing big acquisitions. That is the policy, and but this is an exception for a failing bank, and I think it's actually a good outcome for the banking system. It also would have been a good outcome for the banking system had one of the regional banks bought this company, and that could have been the outcome. But ultimately, we have to follow the law in our agencies, and the law is it goes to the least cost bid.
Let's go to Colby.
Thank you. Colby Smith with the Financial Times. At the March meeting, you mentioned that a tightening of credit conditions from the recent bank stress could be equal to one or more rate increases. So given developments since then, how has your estimate changed?
Yeah, I think I followed that up by saying it's quite impossible to have a precise estimate of the words to that effect. But in principle, that's the idea. You know, when we've been raising interest rates, and that raises the price of credit, and that, in a sense, restricts credit in the economy, working through the price mechanism. And you know, when banks raise their credit standards, that can also make credit tighter in a kind of broadly similar way. It isn't possible to make a kind of clean translation between one and the other, although firms are trying that, and you know, we're trying it. But ultimately, we have to be honest and humble about our ability to make a precise assessment. So it does complicate the task of achieving, you know, a sufficiently restrictive stance. But I think conceptually, though, we think that you know, interest rates, in principle, we won't have to raise rates quite as high as we would have had this not happened. The extent of that is so hard to predict because we don't know how persistent these effects will be. We don't know how large they'll be and how long they'll take to be transmitted. But that's what we'll be watching carefully to find out.
Just to quickly follow up, what does it suggest about the scope for the committee to pause rate increases perhaps as early as next month, even if the data remains strong then, if it's having some kind of substitute effect?
This is just something that we have to factor in as we want to find ourselves. So I guess I would say it this way. The assessment of the extent to which additional policy firming may be appropriate is going to be an ongoing one, meeting by meeting, and we're going to be looking at the factors that I mentioned that are listed in the statement, the obvious factors. That's the way we're going to be thinking about it. That's really all we can do. As I say, it does complicate. We have, you know, a broad understanding of monetary policy. Credit tightening is a different thing. There's a lot of literature on that, but translating it into rate hikes is uncertain. Let's say it adds even further uncertainty. Nonetheless, we'll be able to see what's happening with credit conditions, what's happening with lending. There's a lot of data on that, and you know, we'll factor that into our decision making.
Howard Schneider with Reuters. Thank you. So noting that the statement dropped the reference to sufficiently restrictive, I was wondering, given your baseline outlook, whether you feel this current rate of 5 to 5.25% is in fact sufficiently restrictive.
So that's going to be an ongoing assessment. We're going to need data to accumulate on that. Not an assessment that we've made. That would mean we think we've reached that point, and I just think it's not possible to say that with confidence now, but nonetheless, you will know that the summary of economic projections from the March meeting showed that at that point in time that the median participant thought that this was the appropriate level of the ultimate high level of rates. We don't know that. We'll revisit that at the June meeting. And that's, we're just going to have to, before we really declare that, I think we're going to have to see data accumulating and make that, as I mentioned, it's an ongoing assessment.
And a follow-up on credit, if I could you give us a sense of what the SLUICE survey indicated? It was already, I think 45% of banks were tightening credit as of the last survey. What did this one show, and how did that weigh into your deliberations?
So we're going to release the results of the SLUICE on May 8th, in line with our usual time frame. And I would just say that the SLUICE is broadly consistent when you see it with how we and others have been thinking about the situation and what we're seeing from other sources. You will have seen the Beige Book and listened to the various earnings calls that indicate that mid-sized banks some of them have been tightening their lending standards. Banking data will show that lending has continued to grow, but the pace has been slowing really since the second half of last year.
Go to Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, the argument around the end of last year and the beginning of this year to slow down the pace of increases was to give yourself time to study the effects of those moves. After the bank failures in March, as you've discussed, the Fed staff projected a recession starting later this year. So my question is why it was necessary to raise interest rates today, or put differently, if the whole point of slowing down the pace was to see the effects of your moves, and now you've, for the last 2 meetings, been seeing the effects of those moves. Why did the committee feel it was necessary to keep moving?
Well, the reason is that we, again, with our monetary policy, we're trying to reach and then stay at for an extended period, a level of policy stance that's sufficiently restrictive to bring inflation down to 2% over time. And that's what we're trying to do with our tool. I think slowing down was the right move. I think it's enabled us to see more data, and it will continue to do so. We really, we have to balance. We always have to balance the risk of not doing enough and not getting inflation under control against the risk of maybe slowing down economic activity too much. And we thought that this rate hike, along with the meaningful change in our policy statement, was the right way to balance that.
And just to follow up, what you said in response to Howard's question, you'll need data to accumulate to determine if this is a sufficiently restrictive stance. Does that data need to accumulate, or could it accumulate over a longer period than a 6-week intermeeting cycle?
As I mentioned, I would just say that this assessment will be an ongoing one. You can't, with economic data, you can't. You've seen, take inflation from it. Look back. We've seen inflation come down, move back up 2 or 3 times since March of 2021. We've seen inflation have a few months of coming down and then come right back up. So I think you're going to want to see that, that a few months of data will persuade you that you've got this right, kind of thing. And we have the luxury. We've raised 500 basis points. I think that policy is tight. I think real rates are probably, you can calculate them many different ways, but one way is to look at the nominal rate and then subtract a reasonable estimate of let's say 1-year inflation, which might be 3%. So you've got 2% real rates. That's meaningfully above what many people anyway, would assess as the neutral rate. So policy is tight, and you see that in interest-sensitive activities, and you also begin to see it more and more in other activities. And if you put the credit tightening on top of that and the QT that's ongoing, I think you feel like we may not be far off, or possibly even at that level.
Thank you very much, Chair Powell. Edward Lawrence with Fox Business. So if the Federal Reserve gets down to the 3% inflation, as the projections show at the end of this year, or close to it, would it be okay for you for a prolonged period of 3% inflation and hoping for some outside event to move down to 2% target?
I think we're always going to have 2% as our target. We're always going to be focusing on getting there.
Would you be okay with a prolonged 3%?
You know what? It's let me just say that's not what we're looking for. We're looking for inflation going down to 2% over time. I mean, that's not a question that's in front of us, and it would depend on so many other things. But ultimately, we're not looking to get to 3% and then drop our tools. We have a goal of getting to 2%. We think it's going to take some time. We don't think it'll be a smooth process. And I think we're going to need to stay at this for a while.
How does the other side of the mandate, the job side, once you get to 3%, going from 3 to 2, how does the other side of the mandate balance?
I think they will both matter equally at that point. Right now, you have a labor market that's still extraordinarily tight. You've still got 1.6 job openings, even with the lower job openings number, for every unemployed person. We do see some evidence of softening in labor market conditions, but overall, you're near a 50-year low in unemployment. Wages, you all will have seen the wage number from late last week, and it's whenever it was, and it's a couple percentage points above what would be consistent with 2% inflation over time. So we do see some softening. We see new labor supply coming in. These are very positive developments, but the labor market's very, very strong. Whereas inflation is running high, well above our goal, and right now we need to be focusing on bringing inflation down. Fortunately, we've been able to do that so far without unemployment going up.
Matt.
Hi, Chair Powell. Matthew Boesler with Bloomberg News. So many analysts noted at the time of the March FOMC meeting that at least half of Fed officials' projections did imply or seem to imply that a recession was in their baseline forecast as well, given the strong first quarter GDP tracking estimates. And so I'm just wondering if you could kind of elaborate on, why you're optimistic that a recession can be avoided, given that that's the Fed staff's forecast, possibly also the broader committee's forecast as well, and also, of course, most private sector forecasters.
Yeah, I don't think, I know what's printed in the Summary of Economic Projections and all that. I don't think you can deduce exactly what you said about what participants think, because you don't know what they were thinking for first quarter GDP at that point. They could have been thinking about a fairly low number. Anyway, in any case, I'll just say I continue to think that it's possible that this time is really different. And the reason is there's just so much excess demand, really, in the labor market. It's interesting, as we've raised rates by 5 percentage points in 14 months, and the unemployment rate is 3.5%, pretty much where it was, even lower than where it was when we started. So job openings are still very, very high. We see by surveys and much evidence that conditions are cooling gradually, but it really is different. It wasn't supposed to be possible for job openings to decline by as much as they've declined without unemployment going up. Well, that's what we've seen. So there are no promises in this, but it just seems to me that it's possible that we can continue to have a cooling in the labor market without having the big increases in unemployment that have gone with many, prior episodes. Now, that would be against history. I fully appreciate that. That would be against the pattern. But I do think that the situation in the labor market with so much excess demand, yet, wages have been moving down. Wage increases have been moving down, and that's a good sign, down to more sustainable levels. So I think it's still possible. I think. The case of avoiding a recession is, in my view, more likely than that of having a recession. But it's not that the case of having a recession is. I don't rule that out either. It's possible that we will have what I hope would be a mild recession.
The committee also noted in March that wage growth was still well above levels that would be consistent with 2% inflation. Do you see that as well? And could you kind of explain, how you come to that judgment?
Sure. So we look at a range of wage measures, and then that's a nominal. And then so you assume wages should be equal to productivity increases plus inflation. And so you can look at the Employment Compensation Index, average hourly earnings, the Atlanta Wage Tracker, compensation per hour, basically those four, and many others, and you can look at what they would have to run at over a long period of time for that to be consistent with 2% inflation. They can deviate. Corporate margins can go up and down, and there is a feature of long expansions where they do go down, where labor gets a bigger share toward later in a recession. later in expansion. So, yeah, and we calculate those, and you have to take the precision with a degree of salt. But I would say that what they will show is that, if wages are running at 5%, 3% is closer to where they need to be. Wage increases closer to 3%, roughly, is what it would take to be consistent with inflation over a longer period of time. By the way, I do not think that wages are the principal driver of inflation. You're asking me a very specific question. I think there are many things. I think wages and prices tend to move together, and it's very hard to say what's causing what. But I've never said that, that wages are really the principal driver, because I don't think that's really right.
Great. Chris Rugaber at Associated Press. Well, you mentioned profit margins. Those have expanded, did expand sharply during this inflationary period. And while there are some signs that they are starting to decline, many economists note they haven't fallen as much as might be expected, given that we're seeing at least some pullback among consumer spending. So, speaking of causes of inflation, do you see expanded profit margins as a driver of higher prices? And if so, would you expect them to narrow soon and contribute to reduced inflation in the coming months?
So higher profits and higher margins are what happens when you have an imbalance between supply and demand. Too much demand, not enough supply. And we've been in a situation in many parts of the economy where supply has been fixed or not flexible enough. And so, the way the market clears is through higher prices. So I think as goods pipelines have gotten, back to normal, so that we don't have the long waits and the shortages and that kind of thing, I think you will see inflation come down, and you'll see corporate margins coming down as a result of a return of full competition, where there's enough supply to meet demand, and then you're really back to full competition. That would be the dynamic I would expect.
Michael McKee from Bloomberg Radio and Television. Can you tell us something about what your policy reaction function is, your policy framework is going forward? When you look at the economy at the next meeting, are you looking at incoming data, which is by definition backward looking? Are you going to be forecasting what you think is going to happen? Are you ruling out the rate cuts that the market has priced in?
I didn't catch the last part. Ruling.
Markets have priced in rate cuts by the end of the year. Do you rule that out?
Okay, I got it. So what are we looking at? I mean, we look at a combination of data and forecasts. Of course, the whole idea is to create a good forecast based on what you see in the data. So we're always looking at both, and it'll be the obvious things. It'll be readings on inflation. It'll be readings on wages, on economic growth, on the labor market, and all of those many things. I think a particular focus for us going now over the past 6-7 weeks now, and going forward, is going to be what's happening with credit tightening. Are small and medium-sized banks tightening credit standards, and is that having an effect on loans, on lending? And so we can begin to assess how that fits in with monetary policy. That'll be an important thing. We'll be looking at everything. Again, I would just point out, we've raised rates by 5 percentage points. We are shrinking the balance sheet, and now we have credit conditions tightening, not just in the normal way, but perhaps a little bit more due to what's happened. And we have to factor all of that in and make our assessment of whether our policy stance is sufficiently restrictive. And we have to do that in a world where policy works with long and variable lags. So this is challenging, but we will make our best assessment, and that's what we'll be thinking.
What about the idea of rate cuts?
Yeah, so we on the committee have a view that inflation is going to come down, not so quickly, but it'll take some time. And in that world, if that forecast is broadly right, it would not be appropriate to cut rates, and we won't cut rates. If you have a different forecast, and markets have been from time to time pricing in quite rapid reductions in inflation, we'd factor that in, but that's not our forecast. And of course, the history of the last 2 years has been very much that inflation moves down, particularly now if you look at non-housing services. It really hasn't moved much, and it's quite stable. And so we think we'll have to demand will have to weaken a little bit, and labor market conditions may have to soften a bit more to begin to see progress there. And again, in that world, it wouldn't be appropriate for us to cut rates.
Courtney?
Courtney Brown from Axios. I'm curious how you view the role of the overnight reverse repo facility in the context of the current banking stress. Do you think it's contributing to the stress by making it more attractive for money market funds to compete with banks for deposits? And did the committee discuss any changes to the structure of the facility, or do you see that being put on the table in the future? Thanks.
Sure. So we looked at that very carefully, as you would imagine, and it's really not contributing, we don't think now. It hasn't actually been growing. It moved up, it moved down, and then moved back up to where it was. What happened in the when there were the big deposit flows, which by the way have really stabilized now, what happened was institutional investors took their uninsured deposits and put them in government money market funds, which bought paper from the Federal Home Loan Banks and things like that. Over the course of maybe the last year, retail investors had been gradually, as they do in every tightening cycle, they've been gradually moving their deposits into higher yielding places such as CDs and other things, including money market funds. So that's a gradual process that is quite natural and happens during a tightening cycle. What was unusual really was the institutional investors moving their uninsured deposits and spreading them around and things like that. But it doesn't seem to have had any effect overall on the overnight repo facility. That is really there to help us keep rates where they're supposed to be, and it's serving that purpose very well.
Sarah Ewald-Weiss, CBS News. I want to go back to the debt ceiling for a moment. I know you talked about that in terms of fiscal policy, but can you just speak towards what the impact of a default would mean for Americans across the country, the markets, and borrowing?
Yeah, I would just say it's. I don't really think we should be. We shouldn't even be talking about a world in which the U.S. doesn't pay its bills. It just shouldn't be a thing. And again, I would just say we don't. No one should assume that the Fed can really protect the economy and the financial system and our reputation globally from the damage that such an event might inflict.
Scott.
Thanks, Mr. Chairman. Scott Horsley from NPR. In his report last week, Vice Chair Barr identified a couple of the factors that he thought contributed to the regulatory, the supervisory lapses at Silicon Valley Bank. A policy change in 2019 to exempt all but the biggest banks from strict scrutiny, and also what he called a sort of cultural shift towards less aggressive oversight. You were here in 2019. Do you share that view, and what would it take to get the stronger oversight that you and he said in your release would be necessary?
So I didn't take part in creating the report or doing the work, but I have read it, of course, and I find it persuasive. I mean, I would say it this way: a large bank, not a very large bank, a large bank failed quite suddenly and unexpectedly in a way that threatened to spread contagion into the financial system. I think the only thing that I'm really focused on is to understand what went wrong, what happened, and identify what we need to do to address that. Some of that it may just have been technology evolving, we have to keep up with all that, but some of it may be our policies and supervisory and regulatory, whatever. Well, what our job is now is identify those things and implement them. And that's kind of the only thing I care about and I feel like I am accountable for doing everything I can to make sure that that happens.
Thank you. Evan Reiser with MNI Market News. Chair Powell, are we in the early stage or nearing the end stage of the banking turmoil among regional banks? And secondly, do you still have a bias to tighten rates? Is that what the statement is saying?
So, I guess I would say it this way. There were three large banks, really, from the very beginning, that were at the heart of the stress that we saw in early March, the severe period of stress. Those have now all been resolved, and all the depositors have been protected. I think that the resolution and sale of First Republic kind of draws a line under that period of, is an important step toward drawing a line under that period of severe stress, okay? I also think we are very focused on what's happening with credit availability, particularly, with what you saw in the beige book, and you will see in the sluice, is small and medium-sized banks who are feeling that they need to tighten credit standards, build liquidity. What's going to be the macroeconomic effect of that? More broadly, we will continue to very carefully monitor what's going on in the banking system, and we'll factor that assessment into our decisions in an important way going forward.
Okay, Greg?
Thank you, Fed Chairman. Greg Robb from MarketWatch. I just wondered if you've done any reflection on your own actions during this crisis and leading up to it over the since you've been Fed Chairman. I think I've heard you say a couple of times that you deferred to the Vice Chair for supervision. Do you think that was the right way to go about this? And comments on that. Thank you.
Sure. So let me say, first of all, I've been chair of the board for 5+ years now, and I fully recognize that we made mistakes. I think we've learned some new things as well, and we need to do better. And as I mentioned, I thought the report was unflinching and appropriately so. I welcome it, and I agree with and will support those recommendations, and I do feel that I'm personally accountable to do what I can to foster measures that will address the problems. So on the Vice Chair for supervision, the place to start is the statutory role, which is quite unusual. The Vice Chair, it says, shall develop policy recommendations for the board regarding supervision and regulation of depository institution companies, and shall oversee the supervision and regulation of such firms. So this is Congress establishing a 4-year term for someone else on the board, not the chair, as Vice Chair for supervision, who really gets to set the agenda for supervision and regulation for the Board of Governors. Congress wanted that person to have political accountability for developing that agenda. So the way it works, the way it has worked in practice for me is I've had a good working relationship. I give my counsel, my input privately, and I offer that, and I have good conversations, and I try to contribute constructively. I respect the authority that Congress has deferred on that person, including working with Vice Chair Barr and his predecessor. And I think that's the way it's supposed to work, and that's appropriate. I believe that's what the law requires, and but it isn't. I wouldn't say it's a matter of complete deference. It's more, I have a role in presenting my views and having an intelligent discussion about what's going on and why, and that's my input. But ultimately, that person does get to set the agenda and gets to take things to the Board of Governors, and really in supervision has sole authority over supervision.
Just wondered if you had any regrets, or was there anything that, decisions that maybe you regret now in light of what's happened?
I've had a few. Sure. I mean, who doesn't look back and think that you could have done things differently? But honestly, you don't get to do that. Again, my focus is on control the controllable. As one of my great mentors used to always say, control the controllable. What we control now is make a fair assessment, learn the right lessons, figure out what the fixes are, and implement them. And I think that Vice Chair Barr's report is an excellent first step in that, but we've got to follow through.
Hi there, Megan Casella with Barron's. Did the possibility of pausing at this meeting come up at all, and how seriously was that considered. I'm curious if you can give us any color as to whether there were any initial concerns about raising rates again or what those discussions entailed.
So support for the 25 basis point rate increase was very strong across the board. I would say there are a number of people, and you'll see this in the minutes. I don't want to try to do the head count in real time, but people did talk about pausing, but not so much at this meeting. That there's a sense that we're much closer to the end of this than to the beginning. That as I mentioned, if you add up all the tightening that's going on through various channels, we feel like we're getting close or maybe even there. But that, again, that's going to be an ongoing assessment, and we're going to be looking at those factors that we listed in to determine whether there's more to do.
I'm curious too how to interpret that and the changes to the statement. Is the bar higher now to raise rates at the next meeting, or would a strong jobs report or inflation print be enough to push the Fed to tighten again?
I don't want to. I couldn't really say. I just think I think we've moved a long way fairly quickly, and I think we can afford to look at the data and make a careful assessment.
And we'll go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. You mentioned a few times about the lessons you learned from the banking crisis, that you would learn the right lessons. What are those lessons?
Well, I just would start with something that's changed, really, which is the run on Silicon Valley Bank was out of keeping with the speed of runs through history. And that now needs to be reflected in some way in regulation and in supervision. We know now that we know it's possible. I think no one thought that was possible. No one had. I'm not aware of anybody thinking that this could happen quite so quickly. So I think that that will play through. It will be up to Vice Chair Barr to really take the lead in designing the ways to address that. But I think that's one thing. I guess I would just say that. Then that we're going to revisit. It's pretty clear to me anyway. It's clear that we need to strengthen both supervision and regulations for banks of this size, and I'm thinking that we're on track to do that as well.
Can you be any more specific on the stress testing or looking at banks that have specific concentrations in certain parts of the economy?
Yeah, that's what Vice Chair Barr's role really is, and he'll take the lead on that.
Okay, thank you.
Thank you.
Wow, that was it. That was it. So it looks to be, in my opinion, if I've been seeing this, is that he's being once again very careful with his words. Okay, my face cam is literally dying right now, so I unfortunately have to turn it off. But basically what he's doing right now, he's being very careful with the words he's using. So it looks to be that he wants to keep the door open for a potential rate increasement in the future. So yeah, Bitcoin not really volatile, but if you look at what Bitcoin usually does here, is that if you look at the last meeting at least here, you can see in the last meeting, Bitcoin really started moving after the meeting. So unfortunately my cam died. I'm sorry guys, but let me check. It's not working. Yeah, it's not working. So we'll check that on the next one. But yeah, it's pretty unfortunate that Bitcoin has not seen a very big move here. Of course, still trading in this consolidation phase right here. Still trading in a bigger consolidation phase right here. And basically we're waiting for that next move. Of course, currently in a small profit on my trade. Looking to actually continue this one. I'm not probably going to take profits on the trade yet here. I'm maybe going to put up a little bit more of a tight stop loss here. I'm going to do some more research about this after this live stream. So don't forget to follow me on my socials. This was it for me in today's stream here. It looks to be that literally Jerome is keeping the doors wide open. And really where we should be looking out for is the inflation data. So if the inflation data really comes in lower, lower than expected, it's going to be very good for the markets in general on how they're going to react towards it, and also the Federal Reserve. So yeah, that was it for me on today's stream, guys. Thank you so much for watching. I hope you guys did liked it. I hope, Jerome was being pretty soft today here, so the market has not been really that volatile. So yeah, thank you guys so much for watching, and I'll see you guys on the next stream. Peace out.